Doris, I'm here to share with you about market updates. In the upcoming week, Powell is going to appear at the annual meeting for global central banks, and NVIDIA's earnings report tested the outlook for technology stocks. The global risk aversion has heated up last week as international markets changed and the Federal Reserve minutes hinted that further tightening was needed. Global markets showed that U.S. stocks fell across the board, and the Dow down 2.21% for the week, Nasdaq down 2.59% for the week, and S&P 500 down 2.21%. Europe's three major U.S. stock indexes underperformed. UK's FTSE 100 down 3.48%, Germany's DAX 30 down 1.63%, and France's CAC 40 down 2.4%. This week is a lot to watch, and the biggest focus is the Jackson Hole annual meeting for global central banks, where the Fed Chairman Jerome Powell is going to speak. Major U.S. and American economies will release August Purchasing Managers Index (PMI), focusing on the economic recovery. Many central banks will hold interest rate meetings. South Korea and Indonesia expected to stand still, and Turkey will raise interest rates to about 20%. And the BRICS summit will be held in South Africa. In terms of earnings season, NVIDIA, a popular company in artificial intelligence, will release results. The minutes released last week shows that there are no concern about inflation within the Fed, and further interest rate hikes are not ruled out. However, Fed funds rate futures shows that investors still expect the Fed to remain hold on in September. This week, the annual Jackson Hole Global Central Bank annual meeting is held, and this year's theme is structural transformation of the global economy. Powell will speak on the economic outlook. Powell has given his opening keynote speech at a three-day conference in recent days, which is investors will try to find out the latest clues about the potential rate hikes. With the U.S. Treasury yields near their highest level since the financial crisis, Powell's comments could have a huge impact on global markets. Powell is expected to remain cautious on the inflation, believing that the fight is far from over. A number of Fed officials, including Fed Governor Bowman, Chicago Fed President Goldsby, and others will also make routine speeches. In terms of economic data, the performance of PMI in August is worth watching. The manufacturing sector is expected to remain in contraction territory, and the weakness in the service sector continues. At the same time, durable goods orders are likely to weaken in July. The University of Michigan Consumer Survey will update the August Consumer Confidence Index to focus on the changes in inflation expectations. Crude oil and gold. The international gold oil prices ended a 7-week winning streak due to concern about factors such as demand and a stronger dollar. The WTI front-month contract fell 2.33% to 81.25 a barrel, and the Brent front-month contract fell 2.32% to $84.80 a barrel. Matt Smith, chief analyst of Kepler Americas, said the changes in the direction of supply and demand is still uncertain. OPEC Plus has cut production under the leadership of Saudi Arabia, and demand has been balanced by the economic outlook. Saudi Arabia is expected to continue cut supply to global markets to drive out bearish speculators and support prices. Phil Flynn, senior market analyst at Price Future Group, believes that the bears are no longer pinning their hopes on a U.S. recession, but are now betting on the impact of weak demand. If you are a hedger, it is better to worry about price spikes. The focus is back on the supply side, and the situation may get bad very quickly. International gold prices last week set a record for the longest losing streak in nearly 6 years, and the Fed policy expectations continue to weigh on buying. The COMEX gold futures contract for August delivery on New York Mercantile Exchange fell 1.4% for the week to $1,886.1 an ounce. Strong economic data from the U.S. reinforce expectations that the Fed will keep interest rates higher for longer, driving higher yields and a stronger dollar as the main reasons for gold's decline. Raising yields increases the opportunity cost of holding non-yielding assets such as gold, while a stronger dollar negatively affects the commodity prices in that unit. Commerzbank commodities analyst Barbara Lambrecht said in a note, the recent resurgence in the U.S. Treasury yields has dampened investors' interest, including more short-term speculative financial investors and ETF investors. Lukma Otonuka, market analyst manager at the FXTM, said that for gold, the bears are clearly on the sidelines, and if the fundamentals are right, the bears could further dominate. Gold could be a roller coaster when considering how Jackson Hole Central Bank meeting will provide investors with key insights into the Fed's interest rate stance. This week's Eurozone will publish its PMI statistics from August. German manufacturing index slipped to its lowest level since the pandemic at 38.8 last month, further signaling that Europe's locomotive economic engine continues to stagnate, with weakness in key export market and domestic demand. Germany's IFO business climate sentiment fell to 87.3 in July, the lowest level since October, and the country's economy is likely to remain in recession in the third quarter. In addition, both the French manufacturing and services sector were in contraction as they entered the third quarter. With the energy prices rising sharply over the past weeks, the Eurozone economy may struggle to improve significantly. Institutional forecasts show that the recession in the Europe's manufacturing sector continued to deepen and is beginning to affect the service sector, with a great negative impact. Markets continue to focus on the ECB's interest rate hike prospects, and if the data continues to slow, the central bank would pause the tightening cycle in September. Headline inflation fell sharply to 6.8% in July, but the core consumer price index remained unchanged at 7.9%, which would be a headache for the Bank of Europe. Chancellor of Edgware Hunt said the decline in headline inflation shows the government's action against inflation was working, but had not yet reached the finish line. We must stick to our plan to halve inflation this year and return to our 2% target as soon as possible. Earlier this month, Bank of England raised interest rates by 25 basis points to a 15-year high of 5.25%, the 14th consecutive hike in the key rate. The MPC has not indicated that the era of high interest rates may end soon, vowing to ensure that rates are restrictive enough for long enough to bring inflation back to 2% target. As inflation in the UK is relatively more acute, the market still expects the Bank of England to raise interest rate by another 75 basis points. But the higher the interest rate, the greater the risk of a recession. Institutions expect the UK economy to barely grow in the third quarter, with expansion momentum likely to weaken further as the Bank of England's rate hike cycle puts pressure on the economy. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.